Hello, everyone. Happy Friday. If you are not familiar with who I am, my name is Renad, and I'm the new Wealth Associate here at the Heart Investment Group. Scott is off this afternoon, so I will be taking over the hosting for the weekly Stock Talk. Just a quick reminder, since it is my first time doing this, if you have any questions, please put them in the comment section, and Ben can address them a lot better than I can. That's for sure. Hi, Ben. How are you?
I'm doing good. I'm doing good. Good start. Good intro.
Good. Yeah. Well. So it was a short week this week in the US because of the Memorial Day. Anything interesting happened in regards of the stock market?
Yeah, everyone continues to be focused on the debt ceiling. So it looks like that got resolved overnight officially. So we had a bit of a positive tilt to the markets today. If we look, pretty decent rally. The Dow is up about 700 points today and TSX was up about 350. So pretty good move today. I think the market was concerned about the debt ceiling and that got resolved. So that takes a lot of, I think, attention away from this ongoing debt ceiling debate. So that took a lot of the attention, as well as there were some earnings that came out. Most companies missed expectations again. But the big focus was on the debt ceiling this week.
Yeah, and there is a U.S. central bank meeting happening mid-June. What is the market currently pricing in?
Yeah, so there's both U.S. and Canadian central bank, and presently right now, coming into, I'd say probably 2 weeks ago, there was a 0% probability that rates would go up, but that's picked up a little bit. Something in the neighborhood of 20-30% chance that rates may go up one more time. I think it's pretty unlikely. The jobs numbers came out today. Again, I think the market tended to interpret them as positive, but there were job losses. And if you kind of factor in how the job losses looked, it's a pretty negative number today. Something like 100,000+ job losses in the US. So I think probability of a rate increase is pretty low. I still think they're on hold.
Did you make any changes in our client profiles this week?
I did today for the first time in a while. So one of the companies we bought, I'd say September, October last year was Meta or Facebook. And so it's up something in the neighborhood of 100+% since then. I think it's a great company. I think it's a great company long term, but we've had such a big move and such a big run there. They talked, I guess, today in the news, it came out and said that they're mandating people back into the office a minimum 3 days a week. I mean, I guess the market liked that. I don't know how to answer that. Zuckerberg early on said it doesn't matter where you work, and now they're changing the tune again, probably because the San Francisco real estate market's been under pressure so much. But yeah, took some profits on Meta, Facebook. Like the company, I'd like to buy it back at some point, but it was such a big move. I was happy to take some profits on it. So that was it.
Okay.
The money went into U.S. short-term bonds for now. So nothing really material there. Just short-term bonds can get you kind of 4.5%. So just switch to take some profits. But besides that, nothing dramatically changed for me, and so just taking some profits.
Okay. Should we go on to the chart?
Sure, sounds good. Let's get them teed up here. Still looking around because I'm getting reestablished in the home office.
Someone likes working from the office. That's okay.
Yeah, get used to it. All right, just let me see. Let me know when you can see it.
I see it.
Okay, perfect. Yeah, so this is something we've been talking about on and off now for, I guess, probably a year and a half, 2 years, just about flows and how much of a difference it makes into the markets. And so, if you asked me 10 years ago would I have thought flows made so much of an impact, I would have said no. But now it clearly plays a material part. So if we look at this is bank reserves versus the NASDAQ. So Bank reserves would be the green line here that we've been tracking up and down. This is since May of 2012, so it's 10 years-ish. And the gray line, which you can see, this is the NASDAQ. And so it tracks it extremely closely over a 52-week period, so over a year period. So we watch as reserves expand, so does the value of the NASDAQ. And as we look at how we came into kind of 20, where we saw a big sell-off because going into COVID, obviously, and then we saw a huge influx of capital into the markets, and you saw the NASDAQ kind of follow it on the way up. On the way down, we saw the same thing as liquidity came out of the system, kind of peaking in October of last year, or peaking or bottoming, we'll say. Liquidity bottoming, we saw the NASDAQ bottom around the same time, and we've seen a pretty tight correlation as things have moved up here. Now that we passed the debt ceiling, liquidity is going to start to come back out of the system because the Treasury's been kind of feeding the market right now. And so I'd expect we get a bit of a soft period in growth. And so hence part of the reason to take some profits in some of the tech spaces. The other thing I get a lot of questions about, certainly this is related to rates, and we don't need to go into too much detail on it, but one of the often questions I get is what's happening to the Fed funds rate, and that would be tied to variable rate mortgages, where these would be more fixed rate mortgages would be based off of these. In the US, fixed rate mortgages are based off of the 30-year because they lock them in for a long period of time. In Canada, you'd see kind of the majority of mortgages in this kind of 0 to 5 year range. At least in Canada, usually you get mortgage rates at 5-year fixed mortgage rates at 2% plus kind of the bond rate. So this is a pretty good view about what National Bank thinks about where rates are going. You know, I generally line up with this. Obviously, if the recession kicks in much more deeply than it's presently predicted, I think these rates fall a lot faster. But this was assuming that we get a reasonable kind of sideways to down economic activity and inflation number. You see rates start to come down, and so those would be kind of the forward path for where we see rates going. And so this would give you an idea of what also happens to mortgages. So been following quite a bit just on what's happening with international markets versus US equity markets. So we've gone through long periods of time where you had outperformance by the US market. So that would be the blue ones. So this is when the US outperforms international markets, or EAFE, which is Europe, Asia, and the Far East. This is when those the yellow would be Europe, Asia, and the Far East outperforming US. So we've gone through a pretty extreme period of time here where the US has outperformed international markets. And so, you know, I'd kind of lean towards starting to think about what this means. Is there opportunities in the international space? And, you know, if we're in a recession right now, at some point on the other side of this, the US will stimulate. That'll cause weakness in the US dollar and should be a tailwind for international markets. So certainly something to think about from an equity perspective. Just as I've talked about, I think GDP slowing globally and inflation slowing globally. This is just a snapshot to see, you know, kind of the trade sanctions that are happening in the world. And so this is a material negative impact onto GDP. And so as we have these sanctions that are going on, this continues to be a negative impact into GDP. Will these alleviate? I believe probably they'll moderate at some point soon, but this currently is continuing to be a drag on GDP. Couple more slides, and then if there's any question, we can talk about that. But just on the labor participation rate, so this is something else that we look at, and so it's a reasonable gauge for what's happening in the economy. This is the U.S. market, and so if we look at this yellow line, this one's focused exclusively on 45 to 54-year-olds. Why this is relevant is you had a big influx of retirees in the COVID period, and now you're seeing massive people coming back to work. And so that labor participation rate in that 45 to 54-year-old is rising dramatically. This is, of course, a negative sign for the health of the economy. These people are coming back to work because costs are rising quite quickly. So this is just a sentiment gauge for what's happening in the US economy. So our last two, and then we'll jump on. This is, again, labor force related because today, most of that data came out. So this is a number of hours worked in the US continuing to fall, get a negative sign. And so as the central banks look at this data, because this is kind of the last thing that happens in a recession, is unemployment rises and people start losing the amount of hours they can work. So it'd be another gauge to say where are we in this cycle. I'd say the last one I just want to touch on, obviously we talk about AI a fair bit. It's something I think you need to continue to pay attention to. But I also think you need to take all of this with a grain of salt. Having done this since 2000, I've been through many of these, actually all of these periods where you get these huge breakouts in a certain fad. And AI certainly is getting a lot of attention right now, and I think is more fad-like. But if you look back in kind of the late 90s, AI was starting to be talked about, was front and center at that point. And now AI has come around for a second cycle. It's going to get a lot more attention, but I think we've kind of a little bit over-indexed in some of the stocks that are getting the attention in AI. So we continue to pay attention to this and haven't gotten super heavily invested in it, but I think there'll be opportunities to do so over the next couple of quarters and couple of years. So that was it in the charts today. That was it for the charts today.
Awesome. Is there anything specific you're watching for next week?
So quite a bit more economic data to come out next week, and so I'll be watching those. The unemployment numbers will be coming out in more detail Thursday, Friday next week in the US. And June 7th, I believe, is the Bank of Canada meeting, so be watching for that. Given that we had a pretty big run up today and bonds sold off a little bit, I'd expect we get a correction in equities Monday, Tuesday, and a reasonable rally in bonds and potentially gold as well. So if anything different than that happens, then I may change my view, but the expectation is that's what I'd see happen next week.
Okay, well, perfect. Any questions?
So I'd say on the last thing is, I know you've been reaching out to clients and we've been booking meetings, and so that's great. If anybody does want to book something and we haven't reached out to you, certainly let us know, and you can schedule in some time for them. And I think that's been going well. We've been keeping busy with talking to people, updating profiles, and making sure everything's up to date.
Yeah. Of course, I'm the first point of contact, and I'm very excited to meet all the clients.
Excellent. Excellent. I don't think we have any questions in the queue right now, but I think that was great. You did a great job.
Thank you.
And I hope you have a great weekend.
You as well. Thank you so much.
And we'll see everybody next week.
Yep. Have a good weekend. Bye.
Perfect. Thanks. Take care, Renat.
You as well, Ben. Bye.
Bye. Bye.